Just recently, China's party leadership have reaffirmed their target GDP growth of 7.5%. What does that mean? Well, it likely supports our view that credit growth continues to be at unsustainable levels and will remain so throughout 2014. Just to put some numbers around that, Fitch's forecast for total social financing is around 22 trillion for this year. That in itself will constitute about 17% growth on the number at year end last year. That in itself was up around 21%. Of the 22 trillion, bank loans itself will constitute about 9.5 trillion. The cause for concern about that figure is that an increasing percentage of credit is coming from outside traditional bank loans and the banking system itself. And of course, that's an area that is proving to be more difficult to track and also an area which is less regulated. Official NPLs are around about 1%, but we consider that number to be well understated. Anecdotal evidence already points to pockets of stress within China, and the relevance of that number, and indeed even the recent trends of rising NPLs, seem somewhat marginalised in the context of loan classification being as weak as it is, evergreening of loans being so widespread, and even a third of the system credit exposure residing off balance sheet. So rather than guess how underestimated NPLs are, we look at the loss absorption capacity of the banking system, including under stress. And in that regard, the large state banks can weather something in the order of high single digits, and the joint stock banks and city commercial banks somewhere in the mid-single digits. That might look fine by international standards, but losses do seem feasible to us. More importantly, loss absorption capacity continues to weaken. All bank IDRs in China are underpinned by expectations of sovereign support and therefore have stable outlooks. However, the operating environment in China continues to be quite challenging, and for reasons stated earlier, the bank viability ratings continue to be under pressure. Reflecting this, Fitch downgraded the VRs of 2 banks in December 2013, following on from the downgrade of 3 bank VRs in February 2013. The reasons for this include several factors, they being high rate of credit exposure growth, reduced loss absorption capacity, reliance on wealth management products and other off-balance sheet activity, and thinning liquidity.